Firstly, I want to say I hope everybody is staying safe and healthy. As some of you know, we were planning on holding a live town hall meeting, but after April 6th memo from CAR regarding the stay-at-home order and essential services interpretation, we wanted to wait until we had further clarification. Today, we received much needed clarification from DORA. In a bulletin to members, they stated that we are able to continue doing appraisals and closings as those are considered critical services to complete transactions. Home inspections and final walkthroughs after a buyer has signed a purchase contract are also considered to be essential and are allowed. In-person showings and open houses should be avoided as they violate specific mandates and public health orders. With all that being said, I just want to thank everyone with their patience on this, as I know it's been extremely trying time for you guys and for your clients that really need us right now. Just know that we have been working around the clock at DMAR. We've been on calls and getting clarification from CAR Legal, the governor's office. It has been a crazy 72 hours, but I just want you to know that we are working really hard for you. We're trying to gain clarity for you and for your real estate business at this time. And I just want to say a huge thank you to the DMAR staff and their leadership for their selflessness in working crazy hours to make sure that our members are well informed, as always, and are at the top of our agenda. So I just want to say thank you for your patience. This is a really fluid moment in time that we're dealing with, and things are changing daily and even hourly right now. So we'll keep you updated always when we have the information. With that being said, we're always trying to provide value to our members. That's the number one thing that we're doing here at DMAR, and we continue to do so. We're having a little video series moving forward, and we're actually kicking that off today with the esteemed Nicole Rueth with Fairway Independent Mortgage. She is an integral part of the DMAR machine, and she's a leading light in our market trends committee and also an incredible lender. So without further ado, I'm going to pass you on to Nicole, who's going to give us an update on her industry and everything around that. So thanks so much, Nicole, for kicking this off and being our first guest on this video series.
Well, thank you so much, Euan, for having me. It's a pleasure. There's a lot to talk about, and certainly I could go on for hours and hours about the many things that are happening on a daily basis, a weekly basis, a monthly basis right now. We're trying to squeeze in a lot of information. Every time a decision is made, there's a huge reaction to that decision. So it seems like things are trickling kind of in the wrong order, that the cart is consistently going before the horse. And so we're trying to play catch up. But then you also have this massive economic change that's occurring around us because we can't go to work, because we're all sitting at home. And of course, you have the human element to all of this, which is deeply heartfelt. But to stay on the track of the economic changes, I wanted to show a couple slides. I had the blessing of teaching Warning Graphic Images, the DMAR's Market Trends Committee's update class on Tuesday. And we're teaching another one this coming up Tuesday. So I want to grab a couple of slides from that presentation. That presentation, usually I talk for about an hour, but if I'm going to grab about 20 minutes of that or less, I wanted to kind of highlight some of the things that are going on from an economic perspective to put some of what's going on into context. So I'm going to share my screen really quickly and show you some of those. So here we go. So we've been in the longest expansion on record, right? And I always joke that expansion periods aren't milk. Like, they don't have an expiration date. They expire when they're ready. And this one was getting close to being ready anyway, based on manufacturing. Manufacturing numbers were down, shipping numbers were down. There was a lot of things going on from the fundamental perspective, not from the consumer perspective. Consumers were still spending. Consumers are 70% of the GDP. So while consumers continued to spend and feel good about everything, wages were up, job numbers were up, They were feeling confidence was up. So the economy was strong, even though some manufacturing numbers were down. We haven't been a manufacturing country for a very long time, but we were having some issues from manufacturing. We've been watching this recession period coming for a while. We've been talking about it for months. So here we are, we're kicked into this period, not by an economic situation, but by, regretfully, COVID-19. COVID-19 forced everyone to stay at home, and we saw these ridiculously huge jobless claim numbers. So out of any kind of normal, and I wanted to show this graph because before the last 2 weeks, the largest jobless claims number in 1 week's time was in 1982 when it had hit 671,000. Then just 2 weeks ago, before the $3.3 million or 3.3 number and the 6.6 million number, we had only hit 282 jobless claims in that week. So we're talking relatively normal, if not even small numbers. We've been hovering around 3.5% unemployment, but all of a sudden, everyone had to go home. The jobless claims went way up. We hit 3.3 million, and then the very next week, 6.6 million. We are expecting between 5.5 and 7 million to come out. They come out on Thursdays, so we're waiting for that jobless claims number. In the meantime, we also saw March's headline job number, and that headline job number was low. It was a minus 701,000. I want to put that into perspective really quickly as well, because we usually hover around a 200,000 positive jobs number every month, give or take. And that usually results from 1 million new jobs created and about 800,000 jobs destroyed. There's always a plus and minus, businesses close, jobs close down, but we had a positive 200 running for a period of time. Now this is a monthly number, so to see a minus 700 was a much bigger swing than we were even expecting, but it definitely gives you the impact of what's going on in the economy. There were still jobs being created. In fact, Amazon is creating about 100,000 jobs. Walmart also hired 100,000 people. They have a goal of 150,000 jobs. So there are still jobs being created, just not at the measure of the jobs being destroyed. Those numbers go into unemployment. Unemployment is determined once a month, and it's always calculated based on surveys that happen on the 12th of every month. So that puts these numbers into perspective, because people think, well, they're real time, and they're not at all. So when they come out the first week of the following month, they're reporting on the job numbers that were by survey, mind you. So they're calling households back on the week of the 12th. So whatever day the 12th falls on in a month, they grab that week and they make their calls all that week. So our unemployment went from 3.5 to 4.4%. And you might be thinking, wait a minute, so we just had 2 weeks of jobless claims of 3.3 million and 6.6 million. How on earth do we only have an unemployment number of 4.4? Because we've been hearing it's going to be somewhere between 20 and 30%. Well, this is how that number is calculated. There are 162.9 million civilians in the labor force. These are active people working. So not the children, not the aged, not the injured or on disability. These are the active members who are working in the civilian sector, 162 million. Of those numbers, we were running around 5 million that were unemployed. That's the 3.5 number. And you always have people for whatever reason that are unemployed. That number had bounced up on the week of the 12th to 7.1 million. This is a timing game, because some of the people that rounded into the 3.3 million and the 6.6 million might have already been unemployed or might not yet. And so it all depends on when they were actually laid off, how they answered the phone on the 12th, and then when they actually filed for unemployment. So a lot of that is wiggle room. And of course, we're expecting this number to go up in April when those numbers do come out. For giggle's sake, for probably a reality check, if I were to add 10 million to the 7.1 that was noted the week of the 12th, that unemployment number would be just under 10%. So we're expecting it to be around 10, if not even 12 to 15 when it comes out the first week of May. The all-in number, just for information's sake, is those people that are also underemployed, meaning they took a lesser job, they're working part-time hours. Those numbers are calculated in, and that number always runs higher. But everybody that is looking at this is expecting this to be a hard and fast pop. right? I mean, unfortunate at best, again, but this is COVID. This is not an economic disruption or recession. It's not a mortgage or a housing recession. It is because of the pandemic. So when people are able to go back to work, we're expecting this bounce, right? That unemployment is going to come back down again. The jobless claims is going to come back down again. And a lot of it right out of the gate. So when that happens, we're expecting not a full recovery, because there are going to be people that will stay on unemployment because they're there, or they have to be retrained, or their businesses really did close and they're going to have to find new jobs. And it could take several years for the entire working population that wants to go back to work to find those opportunities. But right out of the gate, restaurants are going to reopen, stores are going to reopen, the malls are going to reopen, and businesses are going to be able to continue to serve. And you have to think about all the people that you're talking to. They're going to want to go to see live music, to go out to eat, to go back to the bars, and to start traveling again, and to see their families and to be reunited. That's going to happen almost right away. So we are expecting both the unemployment and jobless claims to rebound. We're also expecting the GDP to rebound. So right now we've been hovering around 2.1 for a while. This is a number that's based on quarters. So we have the fourth quarter from 2019 was sitting at 2.1%. We are expecting that number for the second quarter. We're expecting that number for the first quarter 2020 to be slightly negative, down 2.5%. Remember, the fourth quarter was 2% positive. This is going to be 2.5% negative. And that's expected because of March. March was so deep that it is taking away from the growth, the incredible opportunities that we had in January and February. So we're expecting a minus 2.5. We're expecting a minus 18% the second quarter, because it is going to take a period of time for us to be able to go back to work and for us to get re-engaged and start to purchase materials again, and inventory, which goes into the GDP. People have to start spending again. But this is the number I want to highlight, because the third quarter is expected to rebound 10%. Now that does not regain the 18% that we lost, but it's a huge bounce back. So that's telling you that the third quarter and the fourth quarter are expected to rebound. In fact, Chair Powell just came out, Fed Chair Powell, this morning saying that he's expecting the economy to rebound, and to rebound in a large way. So we're all hopeful. The economists are saying that as well. This comes from Moody's. FHFA is the other topic of conversation right now, and one that's impacting your clients and my clients. I'm not going to go through what happened over the last 3 weeks, but we've had a series of events that have taken us to here, to where now FHA is starting to be settled, right? Because we have had Ginnie Mae has come out, Ginnie Mae insures, FHA, VA, USDA, and they were late to the game. Fannie Mae and Freddie Mac, which is governed by FHFA, came out right away. And they said that everybody could do a 90-day forbearance, and that we were going to stand up and support any of the servicers. We were going to do what was necessary. We were going to take care of any originations. Well, FHA, or Ginnie Mae, was late in saying that. So when the bill got passed that we had up to 180 days forbearance, and then a second 180-day forbearance was allowed, all of a sudden servicers, and you have to think about, okay, I'm originating a loan, you're selling a home, but those servicers then take those loans, sell them to investors in bundled product, and they have to continue to pay those investors every single month. They have to pay property taxes, homeowners insurance, mortgage insurance every month. That's by contract their responsibility. Well, if the servicer doesn't have any money coming in due to forbearance, they don't have any money to pay their obligations. Well, FHA came out, Ginnie Mae, I keep saying that, primarily we're all looking at FHA, but it's Ginnie Mae, it's FHA, VA, and USDA came out and they said, we're going to protect the servicers. We're going to set up a treasury fund that's going to reimburse them, protect them, insure them against any losses. Because ultimately, servicers aren't a bank. They don't have depository opportunity. They don't have access to the Fed money that has been promised to the banks. So servicers are looking for a need to fill in a liquidity loss. FHFA just came out earlier this week saying that they were not going to step in, that they were not going to set up any kind of liquidity opportunity for servicers. In fact, they were going to play a wait and see game. That could cost servicers a large sum of money, and put some at risk of failure. So we have a number of people, politicians, economists, mortgage professionals alike, trying to reach out to FHFA and get the director to change position. So far, that is not happening. And in fact, he's gone on to say that he's willing to absorb the servicing of any servicer that fails and or resell those servicing rights to another servicer. That's overstepping what FHFA was designed to do and really where they even wanted to go. So where this plays out is the next news cycle. And it's something that we're all watching because it is absolutely going to impact the lenders that are available to originate loans. At Fairway Mortgage, I know that we're going to start servicing our own loans. Not every lender can, but every lender has to determine how they're going to absolve the risk. So let's go into the forbearance very quickly. And I can talk for an hour on this alone, so I'll keep it very quick. Forbearance is not forgiveness. It's our obligation to educate our clients on what it is and what it isn't. And what it is it's an opportunity. There are people that have lost jobs. There are people that need grace. And for that, I'm all for it. But there are also people that might not need it that are taking advantage of the opportunity as it's presented. Because there's no question, if you ask for forbearance, it shall be granted. All you have to say is that you were impacted by COVID. A lot of servicers are starting with 90 days, but they are, as you know, the law was saying 180 days, and then with a second 180 days behind that. All the servicers are following a waterfall approach. They're following a set of if, then, thens, right? So right now they're doing the forbearance plan. So if you call up a servicer, you're going to get automatically probably a 90-day forbearance, anywhere between 90 days and 180 days. And that somewhat depends on the servicer. Remember, these are loans. This forbearance program was for the government-backed loans. It was for FHFA, which is over Fannie Mae and Freddie Mac, and then Ginnie Mae, FHA, VA, and USDA. It is not overseeing portfolio lenders, non-QM lenders, or jumbo. Those are deciding what they will and won't do. Some are not doing it at all, and others are applying the same guidelines. So the forbearance plan is if you ask, it shall be given. So your options at the end of that period of time is to either reinstate, which means pay fully back the 90 days, the 180 days, however many months that is, plus the current month. So if I skip 3 months, on the 4th month, I will be owing 4 months of mortgage that day, right? So that is going to be an extreme pain to a lot of homeowners who might not have, if they don't have the ability to make the mortgage payments for the last 3 months, they're not going to have 4 months of mortgage payments saved up to reinstate their mortgage. So then the options that are going to be presented are in fact granted by the servicer. The borrower doesn't get the choice. It is how the servicer proceeds. And they have the option to proceed with either setting up a repayment plan, which is typically the amount due divided by 12 and over a 12-month period, or deferment, which allows for that money to be reset at the end, doesn't add months, like a 360-month mortgage doesn't become a 366-month mortgage, but it does add it to the end and it would be like a balloon. Or secretary's lien, that's on the government, the FHA, VA, USDA loans, where it sits as a silent second on top of the mortgage. And then the last option is modification, which is a loan mod, which is absolutely going to impact credit. The first options are not supposed to impact credit, but I will tell you right now, there are conversations and it is yet to be determined as to how will a lender look at that gap of time. So there will be a period of months where somebody has not made a mortgage payment, and the question will be, did they take advantage of an opportunity that they might not have needed to? Is that considered a credit risk? I don't know, and I don't have the answers for that, but I do know that lenders are talking about it. And so I would suggest, if you don't need to, I would continue to make your mortgage payments. It is by far the safest option for the continued protection of your credit and your ability to maintain your overall debts. You might look at other options like a cash out refinance to streamline, because I'm afraid there's going to be homes that are going to be for sale at the end of this because people aren't going to be able to catch up or to be able to handle any kind of repayment plan, especially those that might have been in CHFA with low down payment. I don't know, but I do see that that's some opportunities, and it's certainly a risk that we're going to see 3 to 4 months down the road. So on the flip side of everything that's going on, we do have opportunity. And that's where I get so excited, because we do have opportunity beyond this. We had a strong housing market coming into this, and we will have a strong housing market coming out. It is the housing market, in fact, in my belief, that will be the very foundation of the economic strength going forward. One of the things that's creating that demand is the household expansion. And I want to look at this from a population perspective, because this is actually really cool. So if I look at 33-year-olds today and when they were born, for the next 5 years, we see population gain. So those births, those increase in births, will continue to create household formations today. And we're not seeing new builds adapting to this kind of demand. So that's why we have such a low supply right now and increased demand. And we're expecting 8.8 to 9.2 million first-time homebuyers to come into the market. If I compare this to what happened in 2006, and I look at the 33-year-olds in 2006 and when they were first born, well, Roe v. Wade happened then. And for the next 5 years, we actually had low birth rates. So it made sense that we had this huge pop of inventory, which we had anyway because we had a lot of spec homes, but we also had a lower demand. And that created some of what was going on with the housing bubble. That is not what we have today. In fact, not only do we have this large demand, but we also have incredible equity growth. The gift that we've been receiving for the last 7 years has multiplied. And I just grabbed this off of Adam. Adam is a massive data collection company, data aggregator. They put it out by zip code, and I grabbed a handful of zip codes to show the kind of equity that we have. In fact, 37% of all homes nationwide are owned free and clear. They don't even have a mortgage on them. But 26% of those which do have a mortgage have more than 50% equity. So those percentages by zip code are actually the percentages of those homes that have a mortgage and have more than 50% equity. And we're expecting the appreciation to continue. That's the goal line. I mean, the fact is that you can give people hope that if they can hang on to their homes and they can make their mortgage payments, they're going to be better for it. They were better for it in 2008 as well. Anybody that maintained their home came out very strong. But right now, it's more important than ever because the housing market is going strong, and it's also going to have opportunities for those people that do want to come into the market now and purchase homes that, well, maybe Airbnb or investor or CHAFA, first-time homebuyers that don't have equity. There's going to be opportunities for people who do have the ability to purchase. The other 80% of the Americans, the working adults that are still working. So that's what I wanted to kind of share. I had a brief period of time. We have some opportunities. We're definitely watching the FHFA. Interest rates continue to stay low. And historically, every time we're in a recession, interest rates go lower still. So right now, we're in the low to mid threes. If they go lower and we even sit at 3 or 3.25, and I'm just throwing that number out there, but that is a brilliant interest rate, even if that's where we sit theoretically for the next year, maybe even 2, while we recover from what has happened during COVID-19. This is an opportunity where we have to stay positive, we have to stay engaged, and we have to stay in relationship with our clients. So Euan, that is what I wanted to cover today.
That's awesome. I'm trying to figure out how to get back on the the video here. But yeah, what I would say is, question I would have, I think maybe a lot of people, what should you be asking your lender right now if you're a buyer that is under contract and is going to be closing in the next 30, 0 to 30 days? What are the real questions that you should be asking and getting clarification on?
That's a great question, because every lender is different. I'll tell you that at Fairway, and I'm just going to say kind of an example of this, and this is what you've got to ask, because once we change, so we had changed our FHA credit scores were 600, had been for a long time. We bumped them up in the beginning of this to protect ourselves to 660. We've since dropped them back down to 640. We've had to make some other changes. A lot of lenders have had to adjust to jumbos, to down payment assistance, to brokers or non-QM loans. With each change that we've had to make quickly, we've said at this point forward. So every loan that was already under contract or was disclosed and in process followed the old rules, and everything that was new followed the new rules. So that's the question I would ask, because some lenders are following that kind of protocol. Other lenders, you're finding out 2 days before that their guidelines changed and now that borrower no longer qualifies. So I would really dig in with your lender and go, what has been the history that your lender has followed? Has it been that they're changing? Because more guideline changes will happen. This isn't over yet, per se, right? I mean, we're hopeful, we're seeing the light at the end of the tunnel, but we still have more to go. And there will be changes that have to quickly adapt. Like, where does this FHFA insurance go? So as things change, I would ask your lender, can you please make sure that the borrower is qualified today? And are you looking at them based on today's lens or the lens from which they got originally under contract?
Cool. And you know, what's the first thing you're going to do when we get the stay-at-home order lifted?
I'm not going to Disney World. You know, I have 3 amazing kids, and they're all in college, and I was blessed. I was not upset at all when they all left, because they all stayed in Denver. They're all going to the private colleges right here in Denver, so I see them a lot. They're all back home. I love my children very much, but I have a very messy household right now. And when they all came back, and my oldest is a senior, so we had planned a trip to go to Alaska on a cruise. I'm not sure that you'll be able to put me on a cruise for a very long time, but when this is lifted, we're going to plan that graduation trip for my oldest.
That's awesome. Well, that's something to look forward to.